What's going on, guys? Welcome back to Zeconomics. Now, in the last video, we briefly talked about cash secured puts, an option strategy that allows you to earn premium income while waiting for the stock price to hit your ideal strike price to buy in. In this video, we are going to be going over covered calls, an option strategy that is the opposite of cash secured puts. This one, basically, it allows you to earn premium income while you wait for your stock price to hit your ideal sell price. Now, before this video starts, I just want you guys to stay informed that this strategy only works if you have 100 shares of the underlying asset, which means you can earn premium income while you wait for that 100 shares of that underlying assets to hit the right strike price for you to want to sell them. Alright, so a covered call is basically when you own at least 100 shares of a stock like Nvidia and you sell a call option against those shares. This gives someone else the right to buy your stocks at a certain price called a strike price by a certain expiration date. Now, keep in mind, you need to have 100 shares of an underlying asset to exercise this option display. If you don't have at least 100 shares of the underlying asset, what you'll basically be doing is selling a naked call option, which is a very risky play that you guys don't want to get involved in. Now, once you sell the covered call option, you will receive the premium immediately. And let's say you don't want to hold a covered call option anymore. What you'll basically be doing is you will buy back the covered call by paying a premium to close that options play. Now, let's go over the 3 possible outcomes that can happen when you sell a covered call. Let's say you sell the covered call at a strike price of $135 at a certain expiration date for Nvidia. Let's say Nvidia stays below $135 at that expiration date. You get to keep the $300 premium. The share remains yours. They don't get called away. Let's say Nvidia finishes at $125 or $130, which is below the strike price, you're safe, don't get called away. You keep the $300 premium, and that's just basically your income for holding that covered call. Now, scenario number 2 is if Nvidia slightly exceeds $135. No matter how much it exceeds, even by slightly, your covered call, all your shares, your 100 shares will be called away. Your shares will be sold at the strike price of $135 plus the $300 premium you got paid up front. So basically, you would be making $10 per share in gains. If we're including the $300 premium, that's a total of $1,300 in profit. Now, scenario number 3, which is the worst case scenario for you, is if Nvidia moons or rockets up to $160. Let's say you have the strike price as $135. If Nvidia rockets to $160, you are still obligated to sell Nvidia at $135 because of that covered call options contract. So you made a solid return, but you also missed out on the potential extra gain, and that is the trade-off with every covered call options play. All right, so now that we went over what a covered call options play is, let's go over and demonstrate how you can actually sell a covered call. Now, for this demonstration, we are going to be using my favorite brokerage app, Webull. If you guys have some other brokerage app that you guys like to use, feel free to leave them down in the comment section below. I can also do a tutorial on those and send it to you guys. So first of all, once you go into the Webull app, we're going to find the security you want to sell a covered call options on. Now, like I said before in the video, you need to have at least 100 shares of that asset. Webull, unfortunately, it doesn't buy 100 shares for you when you automatically sell a covered call. You got to do it manually by yourself. So you're going to find the covered call option. We're going to do Nvidia here. Once you go there, you're going to hit the options tab and you're going to hit covered call. If you can't find it, it's going to be in the bullish outlook on the options discover page. Here we're going to set our covered call expiration date and the strike price. We're going to be looking at a August 1st, 2025 strike price expiration date, which is 3 days out from here. And let's say we're going to set the strike price at $185. Now, here's the catch here. This sell limit price right here is basically the premium you're going to be paid if you sell the covered call option. Let's say it's going to be at 0.25. Now, every contract is 100 shares. So 0.25 is $25 of premium. 0.25 times 100 is 25. You will receive $25 of premium once you sell this covered call option. So once you sell that covered call option, you will receive a premium in your account immediately. And Let me show you guys how you can see the premium received in Webull. So once you go to the history tab, you're going to go in and hit the orders records, funds record. And from here, you can basically see every options play of the premium received. All right, now that we went over the demonstration, let's go over some strategies you can utilize this to earn long-term premium income on a rolling basis. Now, we're going to be going over what's called a wheel strategy. So how this strategy basically works is very simple. First of all, you have to sell a cash secured put on a stock or asset to generate income while you wait to buy that stock. If you're assigned to buy 100 shares at the strike price, now you own the 100 shares of the stock at that strike price. You will sell a covered call at a higher strike price to generate more income and repeat the cycle over and over and over again. If your covered call gets called away, you then revert back to selling a cash secured put to buy back in at that strike price and sell a higher strike price covered call. And this will help you generate passive income over and over and over again. This is a strategy that you can utilize if you want to generate passive income on selling covered calls and cash secured puts. This is a strategy I really like to use with stocks that I know that it's going to go up in the future, such as SPY or QQQ. Alright guys, I hope you guys enjoy this simple rookie tutorial on covered calls. Now in the next video, we are going to be going over more of the advanced options plays such as credit spreads and straddles. If you guys like this video, feel free to give me a like button, and please, I ask you guys to please subscribe to me because I'm trying to hit 1,000 subscribers so I can get monetized and pay my bills. And most importantly, always do your own research. I don't want you guys coming back and running at me and yelling at me because, oh, Zeke, you made me lose money. I am not a financial advisor. I always urge you guys to do your own research, do your own judgment, and make investment based on your own risk tolerance. And make your own decisions. I'm not here to babysit you. I can only teach you so much as teaching you how to walk. All right guys, I hope you guys have a great rest of the afternoon and stay safe out there when investing.